Welcome to the Opening Bell Report.
Okay, let's just rip the Band-Aid off. Picture the scene. It is Thursday, February 5th, 2026. You wake up, you grab your coffee, you open your brokerage app, and it is just a sea of red. I mean, we are talking about a bloodbath.
It was an ugly day. There's no sugarcoating it.
Ugly is putting it mildly. And sitting right there in the middle of all the carnage, taking an absolute beating, is the company that was supposed to be the chosen one of this whole infrastructure boom, CoreWeave.
Yeah, ticker CRWV.
The darling of the 2025 IPO class.
It was.
And the stock just plummeted, nearly 10% today alone, closing at $74.65. And if you zoom out, this isn't just a bad afternoon. This is a continuation of a slide that has been, well, nothing short of agonizing.
A 60% crash from its peak of $187 back in July of last year.
60%. It's the kind of drop that makes you question the entire thesis. It forces you to ask, is the AI trade over? Or is it just over for this company?
And that's exactly what we need to figure out, because the narrative on Wall Street right now is just pure panic.
Oh, I've been reading the analyst notes. They're all screaming execution risk. CoreWeave missed their 2025 revenue guidance by somewhere between $200 and $300 million.
Right. And the bears are taking a victory lap. They're saying the hype train has officially derailed.
That is certainly the loud narrative. It's what you're seeing in all the headlines.
But, and this is why we're doing this deep dive, if you actually tear apart the 10K and look at the supply chain data, the analysis we have in front of us, Wall Street is getting this wrong.
That's a massive claim to make when the chart looks like a crime scene. You're saying the market is mispricing a 60% drop?
I am, because the market is pricing this drop as a demand collapse. They think the phone has stopped ringing.
They think customers are walking away.
Exactly. But the data shows this is actually a supply bottleneck. And that is a completely different problem with a completely different outcome.
Okay, so in plain English, you're saying people still want the product. CoreWeave just can't build the factory fast enough.
Precisely. And today we're going to unpack why that massive cash burn, which looks terrifying on paper, is actually a defensive moat. We're going to look at the frenemy dynamic with Microsoft and why the biggest company in the world is essentially paying its competitor to exist. And we'll do the math on why at $74, this might be the most asymmetric bet in the market.
Asymmetric is my favorite word. But before we get to valuation, I want to clarify exactly what we're buying here, because I think a lot of listeners hear cloud provider and they just mentally bucket CoreWeave with like Amazon AWS or Google Cloud.
That is the most common mistake investors make. It's a fundamental misunderstanding of the business model.
Okay, so
Amazon AWS, Microsoft Azure, Google Cloud, those are generalists. They are the Walmart supercenters of the internet. You go there for everything.
Web hosting, photo storage, corporate databases.
Right. They do everything for everyone. CoreWeave is the world's first AI hyperscaler. They don't do web hosting. They don't do email. They do one thing: bare metal access to massive compute clusters.
Specifically, high-performance GPUs, the NVIDIA H100s and the new Blackwell chips.
Exactly.
Okay, you use the term bare metal. Let's pause on that because it sounds like marketing jargon. Why does that actually matter to a developer?
It matters a lot. On a generalist cloud like AWS, there's a virtualization layer. It's software sitting between you and the hardware.
To manage resources for all the different users?
Right. And for running a website, that's fine. You don't notice it. But for training a massive large language model, that layer adds latency. It eats up performance. CoreWeave strips that away. You're plugging directly into the silicon.
So if AWS is a Toyota Camry reliable, good for everything, CoreWeave is a Formula One car, stripped of everything except the engine and the wheels.
That's a fair analogy. And it's not just about performance. It's about deployment speed. This was the stat in our research that really jumped out.
What was it?
CoreWeave can deploy a new massive GPU cluster in 6 to 9 months.
Wait, 6 to 9 months?
Yes. Now compare that to the legacy hyperscalers, Amazon, Google, Oracle. It takes them 18 to 24 months to stand up similar capacity.
Hold on. How is that possible? Amazon has infinite money. They have armies of engineers. How is a startup beating them by a factor of 3 on construction speed?
It's the curse of the incumbent. They're bogged down by their own complexity. They have to integrate new chips into old data centers.
Internal red tape, standardized protocols.
All of it. CoreWeave is building greenfield. They find a shell, they fill it with GPUs, they turn it on. They don't have 20 years of tech debt slowing them down.
So while Amazon is filing paperwork, CoreWeave is just plugging in cables.
Essentially, yes. And ask yourself, if you were Sam Altman at OpenAI and the AI race is defined entirely by speed, who are you going to call? You care about who can give you the compute today.
So even though they're number 5 in total cloud size in this very specific GPU cloud niche, they're basically number 1.
That speed is their moat. It's why they're winning the contracts.
Okay, so they are fast, they are specialized. Which brings us back to today, February 5th. If they're so great, why is the stock chart looking like a crime scene? What actually triggered this drop?
It goes back to that guidance cut. The company came out and said, we are going to make $200 to $300 million less in 2025 than we promised.
And in this market, you miss guidance and you get taken out back and shot.
Pretty much. But you have to look at the reason for the miss. Wall Street hears miss and thinks demand is soft.
Right.
But the company was very specific. They couldn't energize the new GPUs on time because of construction delays.
Energize, that's a polite way of saying they couldn't find a plug for the computer.
That's a lot more complicated than that. We are talking about connecting to high voltage transmission lines. The bottleneck isn't the chips, it's the transformers, the substations, the switch gear.
The boring industrial stuff.
The very boring, very essential industrial stuff. There's a global shortage. So CoreWeave has the Ferraris in the garage, but the gas station hasn't been built yet.
And because they can't turn them on, they can't bill the customer, hence the miss.
Correct.
And Wall Street reacted by treating it like a falling knife. I mean, it sliced right through the 200-day moving average at $102, crashed through support at $80. The volume is accelerating.
That's institutional capitulation. It's panic selling. If you look at the RSI, the Relative Strength Index, it's sitting at 28.
So for the listener, what does an RSI of 28 tell you?
It means it is deeply oversold. Anything under 30 usually suggests the selling has been way too aggressive. The rubber band has stretched too far.
So you'd expect to bounce.
Historically, yes. But right now, the trend is just ugly. And it's not just people selling what they own. Short interest is up to 12.5%.
Wow, that's incredibly high.
The short sellers have a very specific thesis. They believe CoreWeave is burning so much cash that they will run out of liquidity before they turn a profit. They are betting on bankruptcy.
Okay, that's the bear case. And to be honest, it sounds terrifying, but you said this panic is wrong. So let's play the contrarian. Why is this a buying opportunity and not a funeral?
It starts with reframing that revenue miss. That revenue didn't evaporate. It moved to the right on the timeline. From late 2025 to early 2026.
Because the customers are still waiting. They didn't just walk over to Google.
They can't. Google doesn't have the capacity ready either. But more importantly, these customers are contractually logged in. This is the number you need to remember. $55.6 billion.
That's the backlog.
That's the backlog. And these are take-or-pay contracts.
Okay, drill down on take or pay. Does that mean what I think it means?
It means exactly what it sounds like. So the customer signs a contract for, say, 3 years of compute. Whether they use it or not, they have to pay for it.
So unless OpenAI or Microsoft go bankrupt, that money is legally guaranteed to flow to CoreWeave.
Correct. It's sovereign-grade revenue. So when the market panics about a $200 million delay, they're ignoring the $55 billion mountain of guaranteed cash sitting right behind it.
That is a huge distinction. But let's push back on the customer aspect. The other bear argument is the big tech threat. Why would Microsoft keep renting from CoreWeave? They'll just build their own and crush them.
It's a logical fear. But it ignores the reality on the ground. We call this the frenemy dynamic.
Frenemies.
Yes, Microsoft is obviously a competitor with Azure, but, and here's the twist, Microsoft is also CoreWeave's biggest customer.
That seems insane. Why feed your competition?
2 reasons. First, speed. We already talked about it. Microsoft is in a deathmatch with Google. They need compute now. CoreWeave is their overflow valve.
So they're just buying time.
Exactly.
Mm-hmm.
But second, there's an antitrust angle. The regulators are watching Microsoft like hawks. By supporting a third-party player like CoreWeave, Microsoft can say, look, the cloud market is competitive. We aren't a monopoly.
That is fascinating. So it's politically useful for Microsoft to keep CoreWeave alive.
It buys CoreWeave years of runway to establish themselves.
All right, let's talk price. Because retail investors look at CoreWeave and see negative earnings. No PE ratio. It just looks like a money pit.
This is the PE ratio trap. If you judged Amazon by its PE in 2005, you would have never bought it. Jeff Bezos was pouring every dollar of profit back into building warehouses and servers.
And CoreWeave is doing the same thing, but on steroids.
Exactly. The losses are depreciation and massive capital expenditure. They buy $1 billion of chips today to make money for the next 5 years.
So if PE is useless, what metric should we be using?
The gold standard for this industry is revenue per megawatt.
Explain that.
In the AI cloud, power is the limiting factor. So you measure efficiency by how much money you squeeze out of every unit of electricity. CoreWeave generates about $1 billion in revenue for every 100 megawatts of power they energize.
And is that good?
It's incredible. It shows that once they get the power turned on, the unit economics are fantastic.
Okay, but we have to look at the financial damage. Let's look at the bad numbers. Free cash flow, negative $7 billion.
It's a huge number. But again, look at what they bought with it. They prepaid for NVIDIA chips. They're securing their supply chain for years. If they didn't spend that $7 billion, they couldn't fulfill the $55 billion backlog.
It's the spend money to make money argument.
But look at the growth that spending bought. Revenue is up 160% year over year. Azure is growing at 15%.
So they're growing 8 times faster.
And here's the kicker. Operating income, the core business profitability, just turned positive. $324 million. The core engine is working.
So if I'm an investor looking at this $74 price tag, how do I value this?
Here's the math the contrarians are doing. At $74 a share, the company's trading at roughly 3.5 times its estimated 2026 sales.
3.5 times sales. For a company growing triple digits, that sounds incredibly cheap.
It is. Palantir trades at 25 times sales. The market is pricing CoreWeave at 3.5 times because they're pricing in a high probability of bankruptcy. They are terrified of the debt.
Which brings us to the elephant in the room, the debt.
$10.5 billion in debt. It is the single biggest risk factor. If the AI boom stops, that debt becomes a crushing weight.
So high growth, massive backlog, but terrifying debt and a stock in free fall. What happens next? What's the forecast?
Let's break it down. Short term. To be honest with you, it's still bearish.
Don't catch the falling knife yet.
I wouldn't. We have a major event coming up in late March 2026. Lockup expiration.
The IPO anniversary. Insiders can finally sell.
Exactly. Early employees, venture capitalists, a lot of them are going to want to cash out. You're going to see a flood of supply hitting the market.
And the class action lawsuits are coming too, I'm sure.
Oh, they're already being filed. It's noise, but it suppresses the stock price. I wouldn't be surprised if we test $65.
Okay, so brace for impact in the spring. What about the long term? When's the turning point?
Mid-2026. That is the bull case.
What changes?
The power turns on. Remember that Core Scientific deal? They signed a deal for 1.3 gigawatts of power capacity.
That's enough to power a major city.
And that capacity starts coming online in chunks in the middle of 2026. That's the bottleneck breaking.
And once that power hits, they can energize the chips and the revenue catches up to the backlog?
Bingo. Analysts are projecting fiscal 2026 revenue to double to $12 billion. If they hit that, and the stock is still trading at 3.5 times sales, the valuation reset will be violent to the upside.
Okay, so let's wrap this up. What's the final verdict on CoreWeave?
It is a high-risk, high-reward play, maybe the highest on the market right now. You're not betting on demand. The demand is clearly there. You are betting on execution. Can they plug in the machines fast enough?
And if you believe that the AI infrastructure build-out is still in the early innings,
then the market is handing you a massive discount because of a temporary solvable problem.
it's scary, but it's fascinating.
It is. And I'll leave you with this final thought. We spend so much time worrying about CoreWeave's $10 billion in debt. It's a big number.
Right?
But we completely ignore their $55 billion in guaranteed contracts.
The backlog.
Think about the gold rush. The old saying is, in a gold rush, sell shovels. CoreWeave is the shovel seller, and usually the shovel seller wins.
But their problem isn't that no one wants shovels.
It's that the line of customers is out the door, and CoreWeave is frantically trying to get the metal furnace hot enough to forge them.
And investors are just betting on whether the furnace lights up before the bank comes calling.
That's the gamble right there.
What a situation. The clock is ticking, and the stakes couldn't be higher. That is all for this deep dive into CoreWeave. Thanks for listening, and we will see you on the next one.
Don't forget to like, share, and subscribe for more.